Are you frustrated with how much you're paying in taxes? In this episode, you're going to discover how you can save $100,000 on your W 2 hard earned income with our top tax strategists, Amanda Hahn and Matt McFarland. Hello, hello. My name is Dr. Rachel Gainsborough, and I am obsessed with all things short term rentals, revenue streams, and helping you navigate your career, real estate, and your busiest and most wonderful seasons of life. So grab your coffee, get comfortable as you get ready to learn and grow with me. This is the Luxury Rental Doctor Podcast. Hello, friend. This season, we are changing things up a bit and bringing you exclusive highlights from our amazing luxury midterm rental wealth retreat. In this episode, we are so thrilled to have Amanda and Matt, renowned real estate CPAs and tax strategists. Now, they're the strategists for people like Beardy Brandon from BiggerPockets. So we are bringing the top guns. These are celebrities in their own right. They're also the authors of the book on tax strategies for savvy real estate investors, published by BiggerPockets, and they are known for really their ability to simplify really complex tax concepts. Now, their expertise help busy professionals, especially medical professionals, save and optimize their portfolios through smart tax planning. This episode features one of our most popular talks from the retreat. Amanda and Matt pulled all the stops and they turned an extremely dry topic into one that was enlightening and very entertaining, to be quite honest with you. With the insights that came in from the talk, guys, everyone was fascinated. They were taking notes like there's no tomorrow, essentially. So I can't wait to share this with you. So let's dive in. We're talking about the essential tax strategies that you need to build wealth. Let's build some of this wealth together, guys. So thank you for joining us today, and let's get started.
Yeah, thank you, Ruben and Rachel, for having us. Hope you guys are having a good time. We got in late last night, so we missed all the good stuff yesterday, but it sounds like you guys have been having a great event. So we will try to keep that momentum going, because obviously everybody knows the spot right after lunch is the prime spot to talk about taxes. So that's what we're here for.
Our specialty is in working with real estate investors on how to save taxes when real estate is one of their wealth building vehicles. And like most of you here, we are also real estate investors ourselves. It's always amazing for us to be here because not only do we get to share our message on how you can save taxes, but we're also learning at the same time too. I took a bunch of notes this morning on all the great speakers and all these new online platforms and technology that's happening. So we're really excited to be here to share our expertise with you guys, and hopefully you can take that home and save on some taxes.
Yeah, just curious, how many guys are actually like working full-time where real estate's a side hustle still, or, okay, a good number of you, okay. But yeah, our client base is probably 90% real estate investors, and that runs the gamut of people who have a job, have some sort of business, but we're doing real estate on the side, to the opposite spectrum where they're doing real estate full-time. And it's rental properties, we got wholesalers, syndicators, like I said, it runs the gamut. But yeah, we're going to talk about some short-term, mid-term rental strategies here today, obviously. But since it is right after lunch, we like to open with a pop quiz. So the way we do these pop quizzes is it's like kindergarten. If you know the answer, you raise your hand quietly. And if we like you, we will call on you. And if you happen to get the right answer, we'll give you a book. All right, so which of the following celebrities went to prison for failing to file tax returns? Tim McGraw, Chris Tucker, Fat Joe, or Rachel Gainsborough?
You only get one try. Raise your hand. Oh, in the
one chance. Hey, Tim McGraw, popular choice, but incorrect.
No.
Miss?
Fat
Joe is correct.
Do you mind passing this back for me? Yay. You're a fan of Fat Joe.
So I don't know, maybe Rachel has gone to prison, I don't know. Not positive. But.
This was just a funny little slide we want to put on here, just to let you guys know that what we're sharing is educational information. Don't run home and implement any of these strategies or ideas without talking to your CPA. We have some clients here. If you hear something, still talk to me before you implement, because we want to stay out of prison, right? That's what we're trying to do, stay out of prison.
Yeah. All right, I think we have another pop quiz question. All right,
No
not yet.
problem. Oh, and this is to share with you guys too that most of you probably already know, but the IRS received a significant amount of funding. I think it's about $80 billion in total to the IRS, and they have 45 million earmarked for audits in the future. And so it doesn't mean that we should stop using tax strategies. It just means that we have to be more careful in our documentation, more intentional in making sure we are actually doing the right things that we should be to get those benefits. I think the key word this weekend you guys have been talking about is receipts, right?
Probably in a different regard, but yeah.
In a different regard, but same concept. Even if we're not talking about the actual receipts, we're talking about documentation. And you'll get a little bit more understanding of that as we go along today.
I think the funny thing about this is that of that 80 billion, we see 45 billion for IRS audits. There was a chunk that's about 3 or 4 billion that's going for what they call system modernization or improve
IT.
correspondence, communication, IT stuff. And I don't know if any of you guys have had to call the IRS in the last 3 years since COVID, but we were hoping that they would flip-flop, put 45 billion to communication, IT support, all that good stuff. But no, unfortunately, they're earmarking for audits.
The opposite. I think like Ruben said, the benefit of us having this really great intimate group is that we can get to know all of you guys. And so as we go through the presentation, if you have questions, just raise your hand and we'll call on you, because if it's relevant to that section, we can go ahead and do that. Otherwise, we should have time afterwards too to take group Q&A, and of course we'll be speed dating as well.
That's what he called it, right?
Speed dating.
Okay, so something we just want to show to you guys here is we call these the silent killers robbing your wealth. Just to put some pictures up there for you. So our highest federal income tax rate now is 37%. Now, obviously, that doesn't, if you're in the highest tax bracket, doesn't mean you're paying every dollar at 37% because we have the graduated scales, right? But again, if you are in the highest tax bracket, the next dollar you pay is at 37%. Now, we happen to be from the lucky state of California where our highest state income tax rate can be 13%. So right there, if you're in the highest tax rate, live in California, next dollar you're paying 50% right off the bat. So that's obviously huge. And then we got other things. Payroll taxes, if you work for yourself, you have your own business, you can be paying payroll taxes of 15%. Real estate investors, we know if we sell real estate, we've got capital gains taxes, that can go up to 24%. And then if you happen to die without a good estate tax plan in place, you could get hit with estate taxes too, which is taxing you on the appreciation that's happened in your assets that you haven't paid tax on yet. So obviously you can see here that this adds up very quickly, right? This is why taxes, there was a study I think we came out a few years ago, but taxes, the average American spends more money on taxes than food, clothing, and shelter combined. So let that sink in for a second, right? That's eye-opening to even CPAs. But yeah, more on taxes than food, clothing, and shelter. But you can see why. Now, what other taxes do we pay that are not on this list? You guys think of any? Sales tax, property tax, right? Yeah.
Yep, gasoline.
She's
tax.
on a roll up here.
Yeah.
Spinning
She's a
off
star
taxes.
student, front row center. So we also put together a pie chart so you can see this. If you're somebody making $500,000 a year of income, and after these various income.
Obviously, this is exactly what $500,000 of cash looks like. So.
I couldn't find a good picture. So after those various taxes, that's what we have left with. Yeah.
Yes. You guys
Yeah.
feeling the pain, right?
If you want to get depressed about taxes, go to taxfoundation.org. That's where a lot of this information comes from. It's a nonprofit that's been around since the 1930s.
That's what we're here to do. We're here to depress you.
Since the 1930s, and every year they do all these studies. So if you want to know, hey, how much am I losing to taxes in my state compared to another state I want to move to or invest in, they have really good information on that.
That's the funny thing, right? If you're working a W-2 job, which a lot of us do, right? Sometimes you don't see it because it comes out of your paycheck. It's going away, but you don't see it. You don't feel it like that. You're seeing the payroll taxes are gone, the income taxes withheld. So yeah, obviously that's a huge, and that's why we're here, obviously, to talk about strategies and ways you can keep more of your cash. Obviously, use that cash to reinvest, continue to build your assets, continue to generate that cash flow. Try not to let the tax drag hurt your wealth building process.
Yeah. How many of you guys have heard people say the more income you make, the more taxes you pay? Heard that before, right? You pay a lot of taxes here because you made more income. New York Times came out with an article about a year and a half ago that said some of these gentlemen made a lot of income, but paid little to no income taxes, right? And the article talked about how they use these really advanced strategies that were only available to the super wealthy. So of course, Matt and I, being the tax geeks we are, we're like, oh wow, what are these super advanced strategies? Let's take a look. So the article talked about a couple of things. One of which was that these individuals were able to access money generated by their assets without paying taxes. So if we translate that to a real estate scenario, right? If we have rental income, we can do the same thing. We have write-offs that we can take against the income. We have depreciation. So we also have write-offs against that rental income so that we don't have to pay taxes on that immediately.
Your property goes up in value, you can borrow against it. You can use that money to go and buy another rental property. When you borrow that money, it's not taxable to you, it's a loan. That sounds a lot like what this article was talking about. You got the interest on the loan. The article is, oh my God, they write off this interest. And so yeah, if you use it to buy an investment property, you can write off the interest as well. Same crazy strategies all of you guys can use, right?
Yeah, they talk about these people are able to sell assets without paying any taxes. What does that sound like? I mean, 1031 exchange, right? Not super advanced, not super secret. It's things that we're all able to do on a day-to-day basis, even just as regular investors, right?
Now, you'd think these people would be smiling more if they weren't paying taxes, obviously, but... So the last gentleman on the right, I don't know if you guys know Brandon Turner. So he was not in the article, but we took the liberty to put him on the screen. He's a client of ours, so we just use him as much as we want. But he's obviously, same scenario, he's been successful building a portfolio, making a lot of money, but using the strategies to his advantage as well and paying very, very little income taxes that he will tell you in his own words, to be honest with you. But
yeah, we joke with him all the time that when we first started working with him, he was a W-2 employee. And so at that time, he was making a lot less money than now, but he was paying a lot more taxes than he is now. So it's interesting how once you understand how the tax code works, it might not happen overnight, right? Some of you who are high W-2 income earners, it doesn't mean tomorrow you're gonna pay no tax. But if you have a plan in place, then hopefully over the next 3, 5, 10 years, you'll get to that same place where you can control how much taxes you're paying.
Yeah, it's all about changing your facts, right? Changing the situation, changing how you're doing things so you can take advantage of the tax code.
Yeah, and the higher income you're in, the higher tax rate that you're in, the more important it becomes to make sure you save on taxes. And the foundation of tax savings starts with understanding what we can deduct legitimately as a real estate investor. And this is true regardless of whether you have long-term rentals, short-term rentals, midterm rentals. Deductions all work pretty much the same way, right? So we're gonna go over some kind of common deductions that we often see missed when we work with real estate investors. Because I think we all understand we can write off mortgage interest, property taxes, insurance, right? Nobody misses those, rarely. But here are some of the ones that are more commonly missed.
Yeah, and this is what we look to as almost like the foundation of good tax planning, is that looking at ways to maximize deductions at the very least. So again, these are some of the things that probably get overlooked more often than not. And part of that, various reasons, right? Part of it, some people just don't know what they can deduct. Unfortunately, some people's, let's call it bookkeeping and accounting, is less than stellar.
No receipts, you mean?
But yeah, it's a various factors, right? They forget about it. It's been a couple months since they looked it over. They forgot that, hey, that money I spent on, that could be a tax deduction because I was talking to so-and-so at lunch about whatever business we were talking about. So high level for tax deductions, it just needs to be ordinary and necessary for your business. So is it ordinary in the sense that what do you do? Is that people take deductions like that and spend money on things like that? If so, then that's an ordinary expense and you should be able to deduct it. Is it necessary? The way the IRS looks at necessary is that, are you spending money for the purpose of generating profit or building your, reinvesting back in your business? That's a big picture look at what you can qualify as necessary expenses.
Yeah. I think the first three, professional development is your ticket here, right? You being here, paying to be here. Business meals. I know Rachel and Ruben have provided all these wonderful meals, but tonight, when we're on our own, have a really nice meal. It's part of you here doing business. Same thing if you're at home locally, if you have a business meal with your spouse, and that's your quarterly meeting where you're talking about real estate, planning for real estate, that could be deductible. If you are meeting with a realtor, a lender, a potential investor, another investor, right? Those are potential business meals. Business travel, of course, flights here, car rentals here.
Contrary to popular belief, we do not have our own plane.
Yeah.
We have been traveling a lot
Who
lately,
said
but we
that?
don't
Oh,
have our
really?
own plane. Not yet, not yet. Home office is another big one. I don't know if you, how many of you guys have a dedicated room at home that you're using as an office, right? So don't be afraid to take that tax deduction, okay? We still hear 20 plus years later that a lot of people think the home office is a red flag in terms of audits, but they actually made it easier a couple of years ago to take the home office deduction because the IRS knows that a lot of people are working from home. You have a question?
So one question, do you have to have an actual room or can it be a space in your bedroom?
So best case scenario, it's a separate identifiable room, but it doesn't have to be. We've seen situations where it's like a area at the end of a hallway or area in a corner. Obviously, home office deduction is going to be based on a percentage of the square footage usually. So obviously, the smaller the space, the smaller the deduction might be. But you can still do it. It's just, you guys know as real estate investors, you guys are all pretty creative, right? So there's a lot of court cases out there where real estate investors try and deduct their dining room table because this is where my office is. And it's, no, I'm sorry, you do eat there every once in a while. So as long as you can justify that that's the only what you're using it for, that should work.
Car expenses, for those of you using your car for real estate, right? Business-related miles are tax deductible, so just making sure you track those. Speaking of tracking, I know that's one thing people just hate to do. Everyone loves to talk about tax deductions. Nobody likes to track it. Nobody likes to have receipts. But I think it's a lot of what was talked about earlier this morning, right? In building a business, this is just part of your business. So making sure that you're working with your CPA or with someone to help you create the systems and the processes so that a lot of these documentation are automatic. If they're happening automatically, then you don't have to be the one to pull your hair out and trying to make sure these things are done or trying to play catch up on some of these. For those of you who are maybe doing real estate even full time and you have a car dedicated to real estate, this year we still also have bonus depreciation. We'll talk about that in a moment with respect to rental real estate, but bonus depreciation also applies to vehicles as well. So we have clients who maybe are flipping or own a lot of rental properties, and if they have a lot of taxable income, could make sense to look at a car purchase before the end of the year to capture that 80% bonus depreciation. $100,000 SUV could get you an $80,000 tax deduction.
So you know what's going on social media right now. Amanda just told me to go shopping for a new car. That's what people are posting right now. I'm seeing the future. But really important, because we get this question a lot too, is misunderstood thing is this works if you are doing real estate passively on the side or you're working a W-2 job. This works if you're a full-time real estate investor. So just because you maybe you're not a real estate professional, we can talk about that later. Oh, am I not getting these deductions? No, you still get the deductions. You're taking this deduction against your rental income. And then if it creates a loss and you can't use that loss for various rules, you still get to carry the loss forward. So don't fall into that trap of I can't deduct it against my income this year. I'm not going to take it. I'm not going to think of it. You want to keep track of all your expenses because they do add up over time, obviously.
Pick what kind of car you want.
You can pick what kind of car you want, yes. For a car, best bang for your buck with a car, if you are going to use it more than 50%, A, use it more than 50% of the time. B, if you can, economically, it works to buy a car that's over 6,000 pounds. You'll get the best tax bang for your buck that way.
All right, have our second pop quiz question.
All right,
Can't answer it until it's she's ready.
All right, in order to deduct my car expense, I must A, hold my rentals in an LLC, B, own my car in my LLC, or C, none of the above.
Okay, it's good to her. C, good job.
I feel like she's seen this before.
She's more advanced, yeah, give her the advanced book. So this is probably one of the most confused areas that we see with real estate investors, probably the number one most frequently asked question as well. Do I need to have an LLC to take any deductions, right? And the answer is no. IRS does not care if you have an LLC or if you don't have an LLC. What they do care about is that you are in the business of real estate, meaning you're a landlord. Again, long-term rentals, short-term rentals, or you're flipping or you're wholesaling, right? There has to be some kind of income generating activity. If you have income activities, then like Matt said, if it's ordinary and necessary, then you can deduct it against that income that's being generated. So don't become a victim to this trap that, oh, I have to have an LLC, because we see this all the time with clients who are like, hey, I have 4 LLCs because my attorney said I have to have all of these before the end of the year so I can take tax deductions. So don't take tax advice from an attorney. Just don't take asset protection advice from your CPA, right? because everyone has their different specialty.
All right, so another what we consider a pillar strategy in terms of tax planning is looking at how do we incorporate other family members into our business. So you guys probably, how many of you guys have kids? Good chunk of you. Obviously, we all know the kids are expensive. And a lot of times people ask the question, can I deduct the money I give to my kids? If you ask 99 out of 100 CPAs, most of them are going to say no. But the question would be, how can I do it? And the way we look at doing it is getting the kids to help you in your business and pay them at just like any other employee. The benefit to you as a family, like again, if we go back to our pie chart earlier, if you're in the highest tax bracket, 40%, you pay your kids $10,000, you're saving $4,000 in taxes. Most kids now, if they make under $13,000 approximately, they're not going to pay any income taxes. So you could be saving at 40%, they're paying at 0% on money that you're already giving them anyway. So why don't we get them to help you in your business, teach them good working habits, a sense of responsibility, spend quality time with mom and dad, right? And teach them the business and get a tax deduction for it at the same time. When I saw this picture, I was like, oh, that's really cool. Like dad's teaching kid how to use Excel, but in reality, this kid's probably teaching his dad how to use ChatGPT or something, right?
Yes.
It's like, Dad, that's so old school, Dad. Come on.
Yeah, in terms of paying kids, there's not really an age requirement in terms of the IRS. That's a question we get all the time. How old do they have to be? How young do they have to be? So it could be anywhere from like an 8-year-old all the way up to if you have an adult child who's 30 years old. Income shifting can happen in both scenarios. We also see that with clients who have aging parents. So maybe you're working at a high income tax rate, but your parents are retired or semi-retired, and maybe they're in a lower tax bracket. So if they can help you out in your real estate, then you can also pay them and it becomes a legitimate tax deduction. So you can see a lot of these deductions that we've talked about so far, we're really focusing on how do we shift some of your personal expenses that you already have anyways, right? Before you couldn't write them off, like your kids, like your car, like your home. Before you couldn't write them off, but now as a real estate investor, you can turn them into legitimate business deductions if they're being used for the business. We're not saying go out and spend money just for the sake of tax deductions, right? First and foremost, you're just looking at
because if you want to do that, you guys can just pay us. All right, so this is just a funny slide going back to the whole ordinary necessary thing. Like these are various court cases that went to the tax court where they found in favor of the taxpayer. Believe it or not.
What's the last one? Got cut off.
The last one is.
Can I see it? Whoa, that is crazy. Swimming pool.
The swimming pool's there. There's another one below it.
Oh, there's another one?
Oh, the last one's girlfriend.
Oh, girlfriend. Oh, we missed that one. Okay. The last, it's girlfriend.
Somebody cut off girlfriend. That's weird.
Yeah, again, these are, maybe it was me.
I don't know.
These are a tax court case. Basically, these are examples where the IRS audited someone or other, and they disallowed it. IRS said, no, you cannot write off wigs, private plane. And the taxpayer went to court and said, I'm going to fight your decision. And these are examples where the taxpayer actually won in tax court. The way.
Sorry, he asked about the girlfriend one.
So
you've been overruled.
Yeah. Not surprisingly, a couple of these on here are court cases from real estate investors because real estate investors are very creative. And in fact, the girlfriend one was a court case about a real estate investor. So it's a gentleman who paid his girlfriend, took a write-off, IRS said no. And he was able to prove in court that he paid his girlfriend because she helped him out with his real estate business. Does that sound like...
She was managing his properties. So yeah, what's that sound like? Income shifting, right?
Shift income to your girlfriend. Now, that would be a problem if you're not supposed to have a girlfriend. I don't think, for those of you who have wives,
don't come to us like, hey, how do I deduct the payments to my girlfriend? Hey, slow your roll, dude. Like,
I was like, what does your wife think about that?
So a funny thing about that is we were speaking somewhere and we were running out of time, and it was like the last slide. We were running off stage, and someone yelled out, this gentleman here just yelled out, tell me about the girlfriend. And I just blurted out without thinking about it, oh, he was paying her for services. And I was like, oh, that's probably not the best way to describe that situation. So yeah, obviously you're not all gonna have every one of these situations, but again, it goes back to, in your business, is there ways to claim tax deductions for things that are ordinary and necessary? And sometimes it may be a little out of the ordinary. Yes, sir.
I'm very curious about
Yeah.
see wigs on there, is that appears, like if I'm gonna speak and I wanna spend X amount on the blazer, like where does that fall in? 'Cause I
Yeah.
heard that's like a gray area.
It's a very gray area, and my answer is unpopular. Generally, the rule is no. So if I buy something nice, I'm here to speak. Generally, is no, even though I do speak a lot. It's a little bit different for people who are like celebrity status, right? For Beyonce going through her whole issue. But yeah, it's subjective. But I would say because everyone's on social media. Actually, yesterday, Matt told me everybody is an influencer now. So social media. So if you are, hopefully you're generating a lot of revenue from there. You're able to show it.
One of the ways they do look at it is like for clothes at least. If you're buying clothes that you can wear somewhere else, the IRS is very strong about that's not a tax deduction. Yeah. But Ruben, if you were going to go buy wigs and dress up in a costume for one of these events, that might be an argument that you could take a tax deduction for it.
Yeah, yeah. Who has this mastered is Rachel. So everything that you have logos on, your logo, your branding, clothing, those are always deductible because that's part of your marketing.
Gotcha.
Yeah.
So this has your name, like
Your company name, short-term gem is everywhere, right? So we share this slide also just as a reminder that when you're working with your tax advisor, always be in the habit of asking, how can I? Like Matt said earlier, can I write off my son? No, you can't. You're just giving him money, right, for video games or his car. You can't write it off. But then if you ask, how can I write off the money I'm giving my son? Then that puts your tax advisor in a more creative mode, right? To say, okay, how can this happen? This could happen if these things are true for you. So adding that one word is really powerful. Again, it doesn't mean that all of us can deduct these things, but if you have something extraordinary, ask.
Speaking of number 5.
Yeah.
All right, one more pop quiz. Tax court allow which of the following people to take a tax deduction for their breast implants? Dolly Parton, Chesty Love, Kim Kardashian, or Bruce Jenner? What?
You got it? Dolly Parton?
Dolly Parton
sure
is a
about
popular choice, but incorrect.
No.
Miss?
Kim Kardashian?
Kim Kardashian is also a popular choice. I think she has implants other places, not...
Bruce.
Man.
No.
If you get this wrong...
Chesty
There we go.
Love. Okay.
Okay. Okay, that's not the way we describe her. We describe her as an entertainer.
Yeah, wait. So, yeah, people are saying they don't know who it is. So, a lot of people don't know Chesty Love, but you just take out your phone and Google Chesty Love, and you'll see exactly why she was able to take a tax deduction.
And then delete your search history right away.
Yeah, you gotta be incognito mode when you do that.
Yes.
So,
So she was an entertainer. We'll call her an entertainer, a dancer. And she did take the IRS tax court and she won. And so the court found in favor that she could deduct her breast implants, but she wasn't able to deduct them right away. Why not? Depreciation, right? They're fixed assets and they have a useful life of more than a year.
yeah. Because it lasts longer than a year.
Yes.
We have to depreciate.
I think it's about 5 years, I think. See, we're doing our best to keep you guys awake,
Yeah.
you know?
Something really interesting, actually. So our question has to be very specific because we have people say, how do you know these other people couldn't write off their breast implants? I think the reality is they probably could all legally write off their breast implants, right? Bruce maybe for medical reasons, Kim and Dolly probably as entertainers. But the technical answer here is Chesty Love because she was the one that went to tax court. She was like the trailblazer of the ability to do that. Thanks, Chesty.
Okay, so talk about tax planning for real estate investors. Obviously, we can't talk about without talking about depreciation. Probably one of our favorite topics. We could go on all day about depreciation. I like to refer to it as like the ninth wonder of the world because I'm a tax dork. Obviously, with depreciation, as real estate investors, we all know the beauty of it is that we're buying properties that are cash flow positive, but the IRS is allowing us to take a write-off or a part of the purchase price every year against that cash flow, right? That's different than if you buy stocks. You buy stock, you can't write off the price of the stock. at least not until you sell it down the road. But this way, we're using depreciation to shelter the cash flow from taxes under the IRS's eyes of that there's normal wear and tear, right? The property's going down in value because you're using it all the time. But obviously, we're hoping it goes up in value. And there's various ways you can do depreciation. There's the standard way with residential property, write it off over 27 and a half years, or commercial property, 39 years. But there's better ways to do it. Rachel was alluding to bonus depreciation. You got assets that are 5 or 15-year assets. Right now, this year, you can write off 80% of those right away. You could do like a cost segregation study, which is almost like supercharging your depreciation expense. So instead of a cost segregation study, when you buy a property, they go in and they look at, okay, how much of the purchase is building, how much is land, then of the building, how much is this really like personal property, these 5-year assets I was talking about, how much of it is like kind of land improvements, like landscaping, shrubbery, that's 15-year property, and then the rest still goes to building. But if you can get 5 and 15-year property allocated out of that and take bonus depreciation, you can get a huge write-off in the first year that you do the cost seg study.
Is there a time limit where you have to be done?
Great question. The question was, is there a time limit you have to do a cost seg? No, there's not actually. So that is misunderstood. A lot of people think they have to do it the year that you buy the property. You can do it 5 years later. The beauty of it is you can pick when you want to do it. So if 1 year, hey, I make too much money, I'm not a real estate professional, I'm not going to be able to deduct a loss if I create one on paper through a cost seg. But maybe 3 years down the road, you're full-time in real estate now. Now would be the time to look at doing that, and you can do it 3 years later.
Yep. And so obviously you don't have to do it before the end of the year. So let's say you didn't file 2022 taxes yet. You could still do a cost segregation now anytime before you file your 2022 return. Okay. So a lot of leeway. I think we did an example. Okay, so we did an example. Let's say you had $30,000 down payment on a property that was $150,000. I don't know where we would find that property, but I would like to find it.
You can add some zeros to it if you want.
All right, what does that look like? Regular depreciation, maybe about $4,600 a year, which is great, right? That means the first $4,600 of income you don't have to pay taxes on. There'll be a natural offset. But if you wanted to do this accelerated depreciation, like what Matt was talking about, then you'll probably get about $31,000 in the first year. So you can see your depreciation in this scenario is more than the down payment that you put in, right? And also something that's really important about depreciation to understand is that depreciation, like Matt said, is based on the purchase price of a property, irrespective of what your down payment is. So we are showing this example of you bought a property for $30,000 down, but the tax benefit would be exactly the same if it was a no money down real estate, right? Because it's only based on the purchase price. So if you had put $150,000 down, still gonna get the same benefit. So I don't know how many of you read Robert Kiyosaki's book, but he talks a lot about debt and taxes and how debt and taxes can make you rich. And this is a great example of how that's done with real estate, because we're borrowing money from the bank to grow our wealth, but we're also using that same money to write off against our taxes.
So how long, what's that timeline, as in how many years? Because the regular one for
Yeah.
property says 27.
Yeah. So in accelerated depreciation, all we're doing is we are taking a building and breaking it out into different components. Certain components you can write off immediately. So this is like an industry average. It'll be different for every single property. But even though you do a breakout, there's always still going to be building left, right? There's not a scenario where there's no building, all components. So the building itself will still be depreciated over 27 and a half years.
Okay, because I was going to say, what happens in like year 3 or year 4?
Yeah, you're getting, as it progresses on, you're getting less depreciation from that same property. But one of the strategies, obviously, the idea is that people are going to continue to buy more real estate. In year 3, you've bought 3 more new properties. You can do a cost seg on those 3 new properties to continue the ball rolling. That's one way to look at it.
Okay, I think we met a lot of you guys, and I think a lot of people here like long-term rental, short-term rental, and midterm rentals, right? So we'll talk about all 3 of them rather than just midterm rentals, because I think similar to like our client profile, people who have a mixture of them, or maybe one property goes from a long-term to a short-term to a midterm. So if we go to the next slide, we can see, we'll talk through the 3 different types of treatments, starting with long-term rentals.
So long-term rentals, from a tax planning perspective, we're looking at big picture question is if we create a loss on paper through maximizing depreciation. One of the big questions all the time is, how can I use that loss to offset my W-2, my other business income? And if you make under $150,000, you generally are allowed up to $25,000 of rental losses against your income. That number does go down a little bit, but that's just big picture. But if you happen to make more than $150,000, and that's single or married, then in order to deduct long-term rental losses against your other income, you or your spouse need to qualify as a real estate professional. And big picture, and we can go into the details. You guys want to ask us questions later, but because we got about 5 minutes left before this timer explodes and disintegrates in our face and stuff. Real estate professional, you got to spend at least 750 hours a year in real estate. You got to spend more time in real estate than your other job or jobs that you have. So if you are working 1,200 hours at a job, then you need to have 1,201 hours on real estate. So 750, more time in real estate. And the other one is you need to meet one of the material participation tests for your long-term rentals.
So basically, if you're a high income earner, over 150,000, you have long-term rental real estate, your tax losses are generally going to be considered passive losses, which means they don't offset W-2 income anymore. They just carry forward into the future to offset future rental income. Okay, unless if you're a real estate professional, but because Matt said one of the requirements is more time in real estate than your job, most people are not going to be able to meet that requirement. And so that brings us to the short-term rental loophole. How many of you guys heard of the short-term rental loophole?
How many of you are investing in short-term rentals? Just curious.
Okay, so short-term rental loophole basically is if you're someone investing in short-term rental properties, then you don't have to be a real estate professional to use these tax losses against W-2. We don't care how many hours you work. All we care about is whether you meet material participation hours. And if you meet material participation hours, then you can use short-term rental losses against W-2 income. So short-term rental loophole is really great for people who have high W-2 income or high income from a business, but also are just investing in short-term rentals on the side. Okay?
I heard somebody in the room was talking earlier. It's like short-term rentals are not passive, right? That's one of the reasons why I think a lot of you move from short-term rentals to midterm rentals, right? Because the short-term rentals are not passive. It takes a lot of involvement. From a tax world, that's what we want. Because if it's non-passive, you actively involved it, you can create that loss and use that loss to offset your other income. Now you can convert it to midterm or passive after year 2 or 3 when you've maximized your depreciation. But that's what, at least from a tax perspective, that's actually a good fact pattern early on.
So to meet material participation in the short-term rental, because that's what we care about. If you meet the hours, you can use the loss. There's 7 different ways to meet it. We'll talk about 3 of them because these are used 99% of the time. The first one is you spend at least 500 hours on your short-term rental, okay? So if you spend 500 hours on your short-term rental, great. You can use all these accelerated depreciation, pay your kids, buy a car. You can do all those against your W-2 income, okay? Not just rental anymore. The second one is you spend at least 100 hours and nobody else spends more time than you. So meaning you have 120 hours, cleaning crew has 80 hours, you're good. The third one is you have any hours, but your hours are more than everybody else combined. So in that scenario, you have 80 hours, everybody else added together is 60. You also met material participation. So you can see why the short-term rental loophole is very attractive for high-income earners, business owners who are not going to quit their job, but they also want to do real estate. So the big question of the day, of course, then is, where do midterm rentals fall? Are they on the short? Do they go under this loophole or do they go under the long-term rental treatment?
So one thing to mention too, short-term rentals for tax purposes, the way they define it is the average customer uses 7 days or less. So keep that number in your head. 7 days or less, we got a short-term rental. 8 or more, you've got a long-term rental, and then we'll touch on the midterm rental where that falls, right?
Yeah. So midterm rental, the good thing about midterm rental is a chameleon, like it could be either or, depending on how you work it. So traditionally, if I just have a midterm rental, assuming it's 30-day stays, and I don't do anything to it, generally that's treated as a long-term rental. So for those of you who have long-term rentals, you already do real estate full-time, that's great. You're already a real estate professional, that's fine. But for those of you who have short-term rentals or you are still working a full-time job, then you want midterm rentals to be treated more like a hotel business because that will be the time when you can use that similar loophole to a short-term rental stay. So hotel type business, very gray area, but effectively the more services you can provide, the better it is. And that's why we were so excited to hear Maddie talk about her business, right? Where you're now helping them with excursions. Maybe they can use a car at your property.
So yeah, if you can get the distinction with that is you get a midterm rental where the average stay is 30 days or less, and you're providing hotel type services, all these concierge type stuff, then it falls into that short-term rental loophole. A lot easier to be able to deduct, if it's 31 or more, which I know some of you have midterm rentals, obviously your 3-month stays. That's more on the long-term rental side of things. But that's as Amanda's saying, you have the ability to change the facts how it's going to fit your situation almost, right? Like what's going to be better in my tax planning? Obviously, what's going to be better economically and where you're going to make more money, obviously too. But keeping all these factors in mind.
And the property, of course, could go from long-term to midterm to short-term, right? As you wish, because you're the owner of the property. All right, we only have a couple minutes. We're gonna go over an example of a client case. So this is an example of someone, I think they had one midterm rental property. For this particular client, it was treated as a long-term rental. It was a married couple, one person working full-time, the other person just doing real estate full-time. So $350 of W-2 income. They had $25,000 of rental income, first time investing in real estate. So they started towards the end of the year, okay? These were some round numbers we did. So they had some income shifting to pay their kids. Their kids were really young.
Yeah, we don't file taxes with just zeros in the end.
Yeah, these are rounded
It's a good way to get
numbers.
audited.
So a little bit of income shifting. Kids were young, right? Nothing super crazy. They tracked their car and home office expenses, so they got some write-offs. Again, nothing crazy, didn't buy a Tesla or anything. But here's the big one. They did a cost segregation study. I think the purchase price of this property was about $800,000. That was the depreciation they got for the first year. And so their income went from almost $400,000 down to $144,000. So it was a $230,000 tax reduction or a reduction of income on their taxes. And so we show this example because a lot of times we talk about, oh, you can write off your car, you can pay your kids, you can do depreciation. But it doesn't, they're all little things by themselves. But when you put it together, you can see how impactful it could be.
Okay, also worth mentioning too is there's a lot of situations where I think you're working with a tax preparer, you assume that, hey, if they're doing my taxes, obviously they know everything about my situation, they're gonna be helping me with my tax planning, right? I'm sure a lot of you have seen that, and we've seen it in our earnings. That's not actually always the case. The tax preparer is probably just putting numbers on a tax return that already happened a year ago, right? Tax planning is being more proactive, right? Like getting ahead of the game, figuring out what's going to happen in the next 12 months and plan accordingly. So unfortunately, if you can find somebody who can do both, great. But unfortunately, it doesn't happen very often.
Yeah. And I think we were talking about, I think every day or after the speakers, you just have some action item, right? There's 3 action items in the workbook. I think one good thing for everyone to just think about is ask yourself the question, do I have a tax plan in place, right? What are my strategies how do I track my
Who
expenses?
is Chesty Love?
Look up Chesty Love in private. So ask yourself that question. And if you have a good advisor, the one main thing that you need to do is to just keep them updated. Let them know before you buy properties, before you sell properties, before you partner with somebody else, right? All you have to do is let them know, and then they'll be able to help guide you through here are the things that you should be doing. If you don't have a good tax advisor, then you just seek out a tax advisor, someone who can help you plan throughout the year. All right, and we'll end with, we put together a free benefits. On our website, we have a lot of freebie stuff, but we put something together especially for this event for Rachel and Ruben. You just scan the QR code. We have 20 tax strategies. They're actually better known as tax myths. So these are all the things that you think are correct about tax strategies, but they are not. And then we also have a tax opportunity finder, which is really amazing for any of you who are wondering, am I overpaying in taxes? Because people ask us that all the time. You can ask us during our speed date, and we're going to tell you we have no idea if you're overpaying in taxes. But this is a self-assessment tool that you can download. I think it's only like 10 or 20 questions, and then it'll give you a score at the end so you can see what your risk level is in overpaying taxes. And the good thing about it is if you're doing good, then great, if you score well. If you score bad, it actually shows you what are the areas that you can maybe improve on. So check those out, and I think we're done with time, so we'll answer it later.
Yeah.
Okay.
Thanks, guys.
Thanks, guys.